Hi, my name is Lawrence. I'm the author of Financial Freedom Through Property. One of the questions I get a lot from my students is it better to invest in a new build or in a property that's been already built many years ago? An example like a CBD kind of area. So in this short series, I'll be analyzing several new builds and just showing why investing in new builds can be risky and can be difficult. If you haven't already, please subscribe, click the notification button, join this tribe. I'll be sharing, as I always do, weekly updates and weekly videos, so make sure that you don't miss out on everything property related in the South African market. Welcome back to another episode of the series of the new build dilemma. Now, new builds is a very attractive way for people to get started in property investing because you're buying something that's shiny, that's new, that doesn't require any maintenance. And new build developers and marketing teams for these companies are very good at painting the picture of a new build being a very good, sound financial investment. In this series, we're going to unpack whether it's better to invest in a buy-to-let or into a new build. And the answer, quite simply, is it depends on your strategy, right? Both have pros and both have cons. If you look at your lower income sort of CBD market approach, you're buying properties for 200,000, 300,000, 400,000. You're renting for 6,000, 7,000, 8,000. You've got more than enough yield to be able to earn a cash flow, a profit at the end of the month. Right, so your income is higher than your expenses, leaving you with a positive cash flow on a month-to-month basis. That's what's great about that sort of lower income market. If you're looking at new builds, the strategy is not cash flow, the strategy is capital appreciation. From a cash flow perspective, 9 times out of 10, the income is going to be insufficient to cover the expenses, leaving you with a negative cash flow in the new build strategy. Right, at least for the first couple of years, let's call it 4 to 6 to 10 years maybe. Now, where the capital appreciation strategy lacks the cash flow, it is strong in the sense that there's a likelihood or a potential for the property to appreciate in value. If you look at your cash flow strategy, the appreciation is going to be minimal, if any. If you're going to see a 3 or 4% capital appreciation rate, that would be probably quite high. Versus your new builds have the potential to appreciate a lot more. Now, I use the word potential and speculation very carefully here because it is a gambling strategy. As much as a developer will tell you that the property is going to appreciate by 8 or 10%, or an estate agent might say that to try and convince you to make a buying decision, the reality is no one knows. And for me, that's why I've chosen the cash flow strategy and avoided the new build strategy, because I don't believe in that methodology. Right, the cash flow strategy, it's about income being greater than expenses. You can predict it, you can plan for it, you get that passive annuity income. The new build strategy works well if you're happy to lose money on a month-to-month basis, but you believe enough in the area that it will appreciate over time. So let's jump into a live example, and I'll take you through how I see a new build investment. Okay. Today we're looking at PropInvest.co.za. I recently, as recent as last night, saw a marketing campaign of theirs on Instagram, so I decided to do a quick video on it today. Please remember that I have no affiliation with any development company. I'm purely giving my opinion and review as an active investor in the property space on the different developers' stock that they have available. I mean no disrespect, and I'm just sharing purely my opinion and perspective. So PropInvest, I haven't seen them before. They might be a newer development agency. So here's that video. I love watching these videos because they give you a sense of what the property's like. So very clean, very modern, beautiful. I don't see this working from a cash flow perspective just because it's... So here's one thing that I've noticed. This is obviously a beautiful restaurant, and they're anticipating, creating a bit of a culture in the estate where you can go for, dinner or walk around or whatever, 24-hour security complex, which is great. But what that means as an investor is that I'm going to have to pay levies. I'm going to have to pay levies for the gardening service, for the security, for the upkeep and the running and the maintenance of the shared services. So that's definitely going to be something that we'll have to look at what the cost is there. Okay, priced at 1.1 in Bedfordview. I don't know that area so well. I think one bed's probably, that's quite a premium price. Expected rental income of 10,500. Again, that sounds quite high. I just don't know the Bedfordview market that well. Maybe we should do some quick research just to find out, what that rental income actually realistically could be. 11.5% net yield. Okay, I don't like this. I don't like it when developers misuse these calculations. The thing is, it's not an 11.5 net yield. It's probably an 11.5 gross yield. So we'll have to go and look at the numbers, because 11.5 net yield means you're making an 11.5 return on investment on the cash flow. So after all expenses, that's your return. Maybe it just doesn't seem. If I see something where they're saying net yield and it's that high, I'm definitely going to go and question the financials and go and do my own due diligence. Now, if they had to say an 11 or 12% gross yield, which is rental times 12 divided by asking price, I would have been fine with that, because that's a fair representation. But a net yield is they're saying the cash flow, the profit you have at the end of the month. Maybe they mean for year one. That's probably what they mean. Monthly surplus of 2,200. Okay, we'll have to look at a little bit more due diligence. Okay, so they've got a lot of marketing speak here, talking about all the services. Okay, area growth at 7%. I don't know, they're making a claim here. I would definitely ask that as a question if I spoke to one of their consultants. Prove to me 7%. I want to see a Lightstone report or some sort of, data analysis that shows that, because that's quite high. Okay, more marketing speak, a bit of architecture. Okay, the deal. Expected rental income of 10.5. So I'm going to go to my app called Pocketlet, and I'm going to run a estimate tool calculator. I'm going to run this on Bedfordview. I want to basically see what average rentals are, because I think the number they've put there is quite high. It's a 1-bedroom, 1-bathroom flat. Let's see what the averages are. It might be that it's 10.5, and in that case I do apologize to PropInvest. I was mistaken, but I don't know, it just seems a little bit ambitious. And I think that's what's important, guys. Every investment, whether it's a new build or an old investment or an old property in CBD somewhere, you always have to do your own due diligence and run your own numbers, because ultimately you're taking the risk of making that investment happen. So the average price from my research is showing 9,200. Maybe because it's a new build, they think they can get 10.5. I think that's a bit high. So the investment summary, okay, they've got the bond, they've got levies and rates and taxes. Okay, you see, this is what they've done. They've included levies and rates and taxes as a non-expense for the year one, and that's how they get to a surplus of 2,200. And then they've taken that times 12 and divided it by, I guess, the money you've put in. So that's how they've got the net yield. I wouldn't say it's an accurate reflection. Yeah, year one, you're going to make maybe 2,200, but you also need a budget for a managing agent, and year 2 and 3, the levies and the rates and taxes come into effect. So it's an okay deal. Again, same thing. Does the capital appreciation justify it? Please click like, subscribe, share this with friends and family. Until next time, happy investing.